went up to 20%, an all-time high. It was the last thing buyers and builders needed, as Michael Vaughn reports.
What a year for real estate, from boom to bust. In the early months of the year in most parts of the country, sales were at record levels and house prices were soaring. But in May, it went flat, because in May, the interest rate on first mortgages reached 18%. Well, this afternoon, it reached 20%, and the market is flatter still. Old houses aren't selling, and not many new houses are being built.
It's going to have a devastating effect on housing starts. We're just simply not going to be able to build more housing this year. Housing has to be affordable, or it's just not going to sell.
Well, 20% mortgage rates is what we needed in 2022, but instead of that, we got a weak Federal Reserve that kept asset prices elevated. And having said that, happy Friday. Welcome back to Real Estate Mindset. Do not forget, everything in this video is going to be chaptered. You guys are going to learn a ton of information specifically about real estate. We're going to do real estate analysis. Everything's going to be updated on the website as well. Got a lot of stuff coming together with the advocacy. Go to my website. I finally got the intro welcome video on the website. I have another 5 videos for the website. I'm excited, you guys. And I also have a Substack. So if you guys want to support the channel, support me, go to the Substack. You don't have to pay for it, but if you want to pay for it, it's there. I am so flipping excited. And I also expect to be owning the roof over my head in about 4 to 5 months as we go into the winter months, because I'm going to show you how to do this, but I'm using the math to find a great deal. I understand that if I purchase a house right now, it's a massive, major financial transaction. And if I make a mistake, I could be out of the everything for 10 years. My purchasing power could be crushed and I may not be able to do anything. So having said that, I'm going to keep this super lighthearted. And I just wanted to say, first of all, good morning to everyone. John, Chris, Scrog, my buddy, Rob, I see you guys going back and forth. I really appreciate that. And Push, what is this? And make them come out. I appreciate you as well. And if you guys can, don't forget to like. There's my man, P Nice. P Nice, where you been, man? I've been waiting to say good morning to you all morning. You guys share this video, like the video. I could definitely use your help. But where we're going to start before we go into the mortgage update, before we go into the real estate update, we're going to start with the economy. We're going to take a look at the market. And when we're going over the market and the various asset prices, I want you guys to understand that I'm showing you this because pensions and 401ks are not it. The pensions and 401ks is a failed idea of retirement. It's not working. And the reason specifically it's not working is fees, commission, and bonuses go towards those financial planners. They're taking all of your profits. So when we're going over this, just remember that. I'm not saying invest in the market. Obviously, we're in a massive bubble right now. But what I am saying, again, is you got to take this into consideration, especially if you have a pension or 401k and you're letting someone manage that. So the first thing that I want to go over today is the Dixie. This is the dollar right here. Now, despite the overwhelming amount of inflation and the massive destruction of purchasing power and the cost of living crisis, the dollar is as strong as ever when compared to the world. 98.94, so super strong dollar, right? The reason that is there's literally nothing in this world other than rocks, metals, that can beat the dollar. So we're literally trapped. We are trapped with this as the world currency. And I say that because they're using it as a weapon, and you and I, mom and pop, the American consumer, is paying for all of this. And that's why our lives, a lot of our lives, not everyone, but most of our lives are in such turmoil. Now, take a look at this, guys. Here is the VIX. Okay, this is the volatility showing us what's going on in the market. Is it stable? Is it not stable? It's barely up today. It's at 1591. I did want to show you guys, though, even though this is completely meaningless, because this is really impacting the algorithms that are used to invest in the stock market, it's still up 24% over 1 year. So not up enough. Usually this is, I think, at $40 going into a recession. So this is reactive. This is not going to tell us an incoming recession is happening. This is after the fact. So it is what it is, guys. But let's look at the indexes now, starting with the Dow Jones opening up sideways. Now I'm going to scroll down and I want you guys to look at the last year of returns for this index. So over the last 1 year, the Dow is up 7.3%. So that's usually a lot more than 401ks and retirements. And remember, I'm not saying invest in the stock market, but there are there are indexes that follow the Dow and the S&P that you could literally just put your money in there and it follows the Dow and the S&P and the indexes. So Dow is up 7% over 1 year. S&P 500 is up over 1 year, 12.8%. So pretty nice gains there. And did I show you guys? Yes. So here was the Dow. Here we go. Okay. Sorry about that. NASDAQ. Okay. So the NASDAQ is up. NASDAQ is winning for the three indexes, up 18.83%. Okay, over 1 year, that's extremely frothy. A lot of people are quitting the market, saying the stock market is going to be bad for the next few years. But right now, it's up 18.8%. But when we look at metals, guys, and metals, again, this is, if you want to know what's going on with the debasement of the dollar and the inflation, look at the trajectory of both gold and silver. So gold is at 42.64, but over the last year, look at how much it's up. Gold is up 60% over 1 year. That is absolutely incredible. And when I go to silver, y'all, look at silver. It's at 58.78. I did a live video when silver was at $29 an ounce, and I said, all right, guys, I'm finally going to take my down payment slowly, not all at once. That would be a huge mistake. Okay, it's very important that you guys understand, right? That the specificity that I'm saying, a little at a time. I started with 100 ounces at $29 an ounce, and then 10, 20 ounces a month. And that's how I got in. But it's almost at $59. And look at it over a year. This is incredible. Oh my gosh. Okay, so year to date, it's 100%. It doubled. But over 1 year, silver, a mindless rock, up 87% in 1 year. Thank goodness I did not buy a house. Thank goodness I took my down payment and I put it in silver, because now it's almost double, which means I don't have to be so stretched when I move into a house. So thank goodness I did that, and I didn't succumb to all the peer pressure of people trying to pressure me into purchasing a house. Bitcoin. Oh my gosh. Massive rebound. This almost hit under 80,000. I think it was this week. It's at 92,000 right now, but look at the 1 year. This was way worse. So it did rebound over a year. It's still down, though, 6.23% over a year. Bitcoin was way worse than this, so it did rebound. Look at XRP, guys. That's down over 1 year, 11.76% over 1 year. Crypto right now, not good. Now, the premise of crypto was decentralizing from the banks, peer-to-peer operations, but that all got muddied when the government started playing around in crypto, and that's why, personally, I'm going to say on the record, I don't know enough about crypto to tell you whether or not it's a good investment, like with certainty. But what I do know and what I do understand about the government, the Federal Reserve, money, the dollar, not a chance that I would recommend anyone invest into this. Okay. Now, if you're wondering why the asset prices are so elevated, why is everyone saying the economy is so good? Well, one reason that is what you see right here, the deficit. We have a $284 billion deficit. Now, I saw on the news, I think it was this morning or last night, someone was like, yeah, the first 2 months of the year, we have a $284 billion deficit. And I was like, what do you mean first 2 months? The fiscal year starts in October. So I just double checked. Yes, this is just for 1 month. So whoever was reporting this on the news said this was for 2 months. It's not for 2 months. This is only for 1 month. $284 billion deficit the first month of the start of the fiscal year. If we annualize this number, we will be in the worst deficit, including lockdowns, in our history. In our history, if this type of overspending continues. I'm really, really surprised to see this number. I expected it to be much lower because of the tariffs, but I also understand we have to service our debt and pay the interest, right? So a lot of different things here, but overall, I am surprised. Now, as far as the inflation, here's the overnight reverse repo quantitative easing market, QE, quantitative easing, bailing out the banks at our cost market. The overnight reverse repo market is sputtering. It's at 2.2 billion. It's pretty much gone, but remember, they could literally inject money in here overnight. So this is just another mechanism that has been created to rob from us, to steal from our money, and to give to the rich. That's what you see right there. Now, as far as the repo market, this is the intervention of the Federal Reserve, quantitative easing. Once again, we still have activity in this market. We have a lot less. I think that's what is at 10 million. I'm sorry, 20 million right now. So not a lot. But anytime you guys see activities in the repo market, the overnight repurchase market, it means there's turmoil. There's turmoil behind the scenes going on, merger and acquisition, fraud, bond, whatever it is, there is turmoil. And that's what that's indicating. So we're going to go to our first video. In this first video, this first video is a doozy. Okay. Did I say good morning to everyone? Good morning. I think I did. Good morning, Ben, Rob. I did, right? P nice. Yeah, I said good morning to everyone. So this next video, it's insane. Okay, we're gonna listen to someone on CNBC talk about how great the economy is. Okay, how it's so great because jobless claims has gone down. Now, the video that I'm going to be doing with Mitch Vexler at the end of this is regarding the Challenger report, which is taking a look at job cuts. And I'm going to tell you guys right now, job cuts, first of all, we've never had the amount of job cuts that we have right now prior to recession. We've only had this amount of job cuts when we've already gone into recession or after. We have never had what we have right now prior to recession. So understand that what you guys are about to hear right now, it's just a tale of two tales. I mean, it's absolutely unbelievable. So comment, let me know if you agree with what he's saying. I find it absolutely incredibly delusional. So let me know what you guys think.
Welcome back to Squawk Box. Rick Santelli here live at CME HQ with important breaking news. Initial continuing claims may be our best kind of real-time evaluation of the labor market. 191,000 on initial jobless claims. That is a really low number. Last week's 216 was the lowest since February. 191. How far back do I have to go? Well, I'll tell you, I have to go all the way back to SEP of 22 when it was 189,000, which takes you back into the 70s to find lower numbers. Now, last week, subtle revision, 216 to 218. It doesn't dispense the notion that if all you're looking at is initial jobless claims to evaluate the labor market, well, according to that, there's not a lot of firing going on. Maybe it is just a hiring story. Now, if we look at continuing claims, a very similar dynamic, just not as pronounced. 1,939,000. That's well below estimates. Last week was also downgraded from 1,960,000, 1,943,000. Now, to find the lower number, the 1,939,000, well, you're going back to, man, that is really something. You're going back to Dece of 24, not that long ago, but it's still a pretty incredible number when you consider where we've come from on all of this. I'm sorry, I'm wrong. To find a lower number, you're going back only to October of this year. Now, if we look at what's going on in the market, we'll look at an interest rate spiking a little bit, and that makes sense. They went down a bit yesterday on the weak ADP jobs report. They're going up a bit on dramatically lower claims, especially on the initial side, because maybe it affects the Fed. I don't think it will. And the Fed doesn't like to disappoint markets. And if it wants to go against what seems to be pricing in to all the contracts that give us a glimpse into what their behavior may be on December 10th, it's locked in at a quarter point, and the guidance doesn't seem to be challenging that. And that really is the key. We need to listen to the guidance and the speak that's out there, but now we're in the blackout period, so we're not going to get much. My guess is that this data won't change what's happening in December, but it might indeed change some of the pricing for 2026. Joe, back to you.
Rick, this is we're getting whipsawed, and we had the pallbearers out yesterday on that ADP number. The small businesses in the United States and the mom and pop businesses in the United States are ready to close up shop and go hit the soup line, the soup kitchen lines. Then this comes out. How do you mentioned that maybe they're not hiring? Would that work? Is there any other way that you can explain which signal we're supposed to say is the real one for the labor market? Which one should we pay attention to, or both?
Well, I think claims is a good area to pay attention to. Now, granted, there are issues across the country of reporting problems, maybe accuracy issues on a state-by-state basis, but let's compare that to some of the issues with the Bureau of Labor Statistics or some of the other entities that compile data that, at least for the last couple months, has been restrained. We all know that the jobs report we're supposed to get this Friday is going to be released a couple of weeks late. But I do think that there's accuracy issues no matter where you look. I personally think that initial jobless claims is giving us a type of picture of the labor market that I certainly wouldn't dismiss out of hand. And I do think that we are in a situation where maybe there's less hiring for a variety of issues that over time may clean up a bit. We all know that many look at the dark side of things like tariffs, and there may be a dark side to them. And maybe that does impact smaller businesses that aren't as equally or able to spend the time or the money or the resources to try to navigate some of the complicated issues. But in the end, this is a period of transition. And I do think that those small businesses at some point down the road, if that really is the weak link in the chain on hiring, will come back. We all know the big, beautiful bill has a lot of positives that will positively affect small businesses of the future and their hiring prospects.
Well, tell me what you guys thought of that. So do you think he's on point? Do you not think he's on point? I'm going to go into our next segment, which is our mortgage update. And you guys, if you wanted to learn about how mortgage works and the history of mortgage, this is a segment for you, because this is going to be a huge learning lesson that I'm about to show you guys. But I was interested, what do you guys think of what he just said? And also, when I get to the real estate section, excuse me, I'm going to be asking you guys for a subdivision in the Houston area so that I can do a live on-air analysis, finding both cash flow and a wedge. So I'll get that from you guys in a second, but just tee that up. I do need some subdivisions. Economy is toast. Not on point. A bunch of cheerleading. Yes, yes, yes. I agree. I agree. That's it. That's all the feelings you guys had. A couple comments though on when the video was playing. Anyways, I thought you guys would have more to say about that. It's hard to listen to it. It's hard to listen to these. It's just absolute nonsense. So let's do our first time stamped in on our mortgage update. And you guys are going to learn, like I said, if you wanted to know how mortgage worked, you guys are going to get a lot right now, a lot of details. So let's first talk about the long end of the bonds right now, which is the 10 years. So mortgage rates really don't track the federal funds rate. They have a little bit of an impact on the mortgage rates the federal funds rate does, but not overall. What you really want to watch is the 10-year treasury or even the 30-year treasury, and usually the trajectory. So if it's going up or it's going down, mortgage rates follow that trajectory. The yield has actually been decreasing recently, because usually when we've been tracking this 10-year had to be under 4% for residential mortgage rates to be under 6%. But that has changed. So regardless, this has basically been sideways this whole week. When we go to mortgage rates, really surprising to see. I mean, I don't know about you. I'm surprised to see this. The 30-year FHA went down even more. It went up yesterday, but from our last live, it went down. That's crazy to me. It's sitting at 5.86. Now, remember, if you're shopping your mortgage right and you're taking advantage of the grace period for the inquiry on your credit, at least for me, I can get a half a point off of everything you see here. So on a conventional, which is the upper left at 6.24, I could probably get a 5.75. And on an FHA, and this is same to you if you have good credit, I could probably get something like a 5.375. Now, once again, on the upper left is conventional, on the right is jumbo. You're going to notice that it's a higher rate for jumbo. So it goes from 6.24 to 6.39. The reason that is something called risk. Okay, so the more risk, the higher the rate. That's called technically LLPA, which is loan level pricing adjustment. So I'm going to get you guys a lot more info on that. But before I do, I want to go over this. When it comes, especially if you're a first-time homeowner, even if you're not a first-time homeowner, the two most important things, let's talk about the first one, when it comes to buying real estate, is understanding how the debt works, okay? A lot of people are like, no, debt's great. And a lot of people are like, no, debt's horrible. The reality is it really depends on the deal that you get and what you do with the debt after you get it, because it could be good, but most of the time it's horrible. It's horrible, okay? And the reason mortgages are usually so horrible is you literally never pay your loan off. Most people just refinance and start this whole thing all over again. Now, just to put this in perspective, on a $450,000 loan at a 6.24% interest rate, you're going to pay back more than the loan amount. So the overall interest is over 100%. You pay back $546,000 in just interest, okay? The first year, because this is front loaded, remember, these loans are front loaded. The first year you pay $27,000 in interest. The 30th year, you only pay $1,000 in interest. So if there's one thing that I want you guys to remember about me, it's that you have to pay your loan off early. And you don't even need to do a lot. You just need to do a little bit extra per month. If I only put, as an example, $100 extra towards the principal per month, okay, let me calculate this. I save about 3 years and 60,000, and that was only $100 a month. Imagine if it was 300. So $100 a month, I save almost 3 years and $60,000. And you guys remember, by paying extra money towards principal, that's my money. I can technically get the money back. So I'm not even paying down principal. I'm just paying myself back, because if I sell, I should, depending on the market, right, get that money back. Paying your mortgage off is one of the best things you could do. And when I listen to Tucker Carlson, he's like, one of the reasons I left Fox is I paid my mortgage off. I wasn't trapped anymore, so I left Fox. I don't know if that's true, but that's what he said. Now, as far as the training, this is so important for you guys to understand. This is the most important thing. Interest rates don't go up and down every day. The price of interest rates go up and down every day. And what you guys see here is a rate sheet, okay? And so when it comes to locking your interest rate, you can do that at par, which means there's no cost or no credit. You can do that with a rebate, meaning that you get money back, or you could do it at a discount, meaning you have to pay money to get a discounted interest rate. What does everyone want? They want the free interest rate. That's par. Now, when we look at this, okay, your interest rates are right here. This is for a 15-year. It goes from 3.875 to 5.25. You can lock it for 10 days, 30 days, 45 days, and 60 days. The longer that you lock an interest rate, the more the cost goes up, okay? So as an example, if I wanted to lock this interest rate right here where my mouse is 4.5%, if I wanted to lock that for 30 days, the cost to me is 2.6%. So if my loan amount is $100,000, that cost of 2.6% means that I would have to pay an extra $2,600. Okay. So just come back to this video, look at this rate sheet, and understand that you usually want a par interest rate. Now, when we go down here, this is also pretty cool. Okay. When it comes to loan to value, this represents pretty much, if you're purchasing, this represents your down payment. What I want you guys to understand about loan to value or down payment is that's also an LLPA, loan level pricing adjustment. So the more you have down, well, depending on the type of loan, the better the interest rate will be. Depending on if it's conventional, because they want you to have mortgage insurance. But the tiers, and this is what I wanted to show you, they go in increments of 5%. So it's either 5%, 10%, 15%, 20%. It doesn't make sense to put 8% or 22% down. You go in increments of 5. You see that? So it goes from 70 to 75 to 80 to 85 to 90 to 95. That is your LLPA adjustments for down payment. Let's keep going. I'm going to show you guys the adjustments for credit as well. Here's your credit score adjustments. This is saying the maximum credit score for rate pricing is 780. Usually it's between 740 and 780. My credit score is above 780. Hopefully yours is as well. But what I wanted you guys to know is this goes into tiers of 20. So 620 FICO score, 640 FICO score, 660. Now, when it comes to qualifying for a loan, the FICO score that's used is whatever your middle FICO score is and whatever borrower has the lowest credit score. So if a husband and a wife are on the loan, the credit score used is whoever has the lowest middle credit score. Don't forget that. So sometimes if a husband and wife have bad credit score, one of them has a good credit score, you could sometimes remove one of them off the loan to remove their credit score, so long as you still qualify for the loan based on debt to income ratio, because you would be removing their income if you remove them from the loan. Now, one other thing I wanted to show you guys is documentation type, because one of the things that drives me crazy is when people, and because I was like, wow, it's finally here, is when people say ninja loans. If anyone says a ninja loans, usually they're talking to you and they're a sales agent and they weren't around during the global financial crisis, or if they were around during the global financial crisis, they weren't in lending like I was, because there was never ninja loans, ever ninja loans. It was Nina or CISA or SIVA, okay? It wasn't ninja. There's no such thing as ninja, okay? And I highlighted that right here. Here, back in the day, were the different types of documentation required. And now it's pretty much full doc or 12 months of bank statements. That's really all we have now. But here it is right here. Look it. It's Nina. It's not ninja. I told you guys. And it stands for no income, no assets. And SIVA stands for stated income, verified assets. There's no ninja. And CISA is stated income, stated assets. There's no ninja. They just say there's a ninja. There's no ninja, you guys. So, in other words, that's about it on mortgage, okay? You're going to want to shop, people. You generally look at the cost and the interest rate, okay? And don't forget, I have an entire class on how to purchase real estate. So if you're interested in purchasing real estate between now and the next year, take that course. It's for free. And I'm going to tell you right now, in no way am I saying purchase real estate right now in mathematically the worst time in history to buy real estate. What I am saying is just learn how to do it. Just learn how to do it. We can't do anything else right now. Well, depending on if you can find a great deal. So just take a breath, learn how it works, and everything will be fine. So, oh my gosh, this next video is insane. I can't believe I forgot about this video. This video, you guys, if you've been watching me, this next video is going to drive you crazy. We're about to listen to another realtor shill, okay? Talk about how, oh, we need more inventory. And if we needed more inventory, then inventory wouldn't be skyrocketing up. Now, granted, there are some areas, especially on the northeast, where the zoning laws are such where they do need more new inventory, but they have changed it. We are now no longer short 4 million houses. Okay, so we're no longer short 4 million. We're now short 5 million. So even though we can't sell what we have right now, they added another million that we're short. I mean, this guy, absolutely out of his mind. Let me do this timestamp real quick. Let me know what you guys think. Comment below and why I'm doing this. Remember, our next segment is our real estate segment. So if you can, right now, as this video is playing, tell me a subdivision in the Houston area that you want me to analyze. So comment your subdivisions right now. Either way, enjoy the video. This is absolutely crazy. Listen to this shill.
Forecasting a slightly better market for 2026 after a couple years of some tough sledding. Real estate brokerage Redfin with a similar prediction. Former president of the National Association of Realtors is Kevin Sears. Kevin, good morning to you. Hello. How did your testimony go?
Good morning, Bill.
How'd your testimony go on the Hill? Did they beat you up a little bit or not? Did you come out okay?
All in all, I'm very happy with how the testimony went yesterday. Had a great conversation with the House Financial Services Committee, and we talked about real action that can be taken to help solve the housing crisis that we find ourselves in.
Okay, we need some solutions. Here we go now. For 2026, this is the projection now. Real interest rates at 6.3%. The expected for 2025 was 6.6. That is a lot higher than Trump 1.0 going back to 2019. Kevin, how do you see that?
Yeah, I mean, any price relief we can get on interest rates will certainly help, but that won't solve the affordability issue that we have. It's really simple economics. It's supply and demand, and we have severely underbuilt in the last decade and a half. In fact, we are down approximately 3.8 to 5.3 million homes, depending on who you talk to. And so let's just say 5 million homes. We have fewer homes on the market right now than we did in 1995. And in that time, our population has grown by tens of millions of people. So this is something that has been developing over decades, and we need to have solutions put in place today to solve it for our kids and our grandkids.
Remember when interest rates were 3% and everybody said, you got to refinance. You got to do it right now. I'm sure a lot of people are looking in the mirror saying, missed that boat. Here we go now. The percentage of income that is spent on the mortgage payment. All right, put it up, guys. Number 2, 30% of income. That's a lot right now. And the screen to the right, the percentage is 29.3% of median income. It's the first year since 2022 we've been below 30%. I'm going to say that's an improving market, all right? But I mentioned Redfin. Here's the CEO in a prediction for 2026.
2026 is going to be the year that things start to get better. It's not going to be some overnight sensation, but it will be an improvement where home prices grow 1% and wages grow 3 or 4%. That means that housing will get slightly more affordable. And that's good news because America needs a break.
Okay, does that reflect what you're seeing?
Absolutely. You know, one of the things that I talked about yesterday with the House Financial Services Committee is pushing them to approve the More Homes on the Market Act, which would double the capital gains exemption on primary residence. Right now, we have a lot of inventory that baby boomers are sitting on, but they're nervous about paying the capital gains tax. And if we were to get that raised to $500,000 for a single person or $1 million for a married couple, I believe that that would free up inventory. And when we have more inventory on the market, that will help with the affordability issue that Americans are facing right now.
Okay, here is slightly good news on the rental market, all right? Rents have been going super high now. National median rent for an apartment down 1% from about a year ago, down 5% from a peak in 2022. However, record high 7.2% for multifamily vacancy rent. Does that make sense to you, Kevin?
No, the numbers on their face don't make sense. I'd sure love to be able to dig into them a little bit, but the rental market has been a key driver in this. And so what we need to be able to do is have affordable rent so that these tenants can save up for a down payment to achieve the American dream of home ownership. Listen, one of the things that we're seeing across the country is that this is not a red issue. This is not a blue issue. It's an American issue. It's a red, white, and blue issue. And so anything that we can do to unlock inventory, to get more homes built, to get more multifamily homes built, that will help us solve the affordability crisis that the Americans are seeing right now.
I like that last comment a lot. Thank you, Kevin, for coming on. We got a builder in the White House, so let's build.
Short 5 million houses. Absolutely unbelievable. So we're going to do a real estate analysis now, you guys. And here's the thing. So here's an interesting comment. This guy's been all over the thread. It's actually hilarious, but he's like, dude, I'm getting offers unfixed with nothing updated. You know, these people never say their market. And why would someone be, why would someone be making, here's the thing, you guys. I don't know who these people are that are making comments like this. Maybe they really believe what they're saying. I ask that all the time. But the good news is it doesn't matter what anyone says. It doesn't, their emotions, their business partners, it doesn't matter what they're saying. The only thing that matters when it comes to purchasing real estate is taking raw data and knowing how to analyze it. That's it. That's all we have to look at. Every subdivision and market is different. And within those markets, some houses are still overpriced and some houses are not overpriced. So what I can tell you in my market here in Houston, inventory is absolutely exploding. Price cuts are everywhere and things are sitting on the market a lot longer. And we have existing homes and new homes competing against each other, as well as builders competing against each other. So here in Texas, we got a lot of things happening, but there's a reason why. And so anyways, I thought it was really important just to reiterate the fact that there's just a lot of people that are insecure about the housing market, and that's fine because all we have to do is use the math. And that's going to bring us to our next segment right here. And we're going to use the math. This is going to be uploaded into our lesson. Let me switch. Okay. So now the first thing you guys need to do when analyzing a property, let me get my notes here so I can get everything. Now you come to the website. This is my website right here. And by the way, I finally have our video up. Then we go to the home buying. And by the way, you guys, I have all of these tabs redone as well. Home buying, protest property value, abolish property taxes. You go to this tab here, litigation support, tax protest, criminal complaints, school bonds. The advocacy is coming together. But I want you guys to go to home buying tab. Again, this is all free for you guys. I start with this video, so you'll have to watch this video. It's a warning, basically video, but where you're going to come is you're going to, if you don't already know, you could take this, how to do a market analysis. This is going to teach you how to use the data and not listen to people that are emotionally charged, or maybe they really believe what they believe. But either way, I'm going to update this weekly. So if you go to this course, you can always find recent analysis. Now we're going to download this form right here, which is our subdivision analysis form. Okay, so this is what we're going to complete today. Now, the reason why it's so important to complete this is when I go into my hold on one second. My MLS, this is active MLS. It shows that I have over 100,000 listings. And I don't want to look at 100,000 listings. I only want to look at homes that I know are undervalued because I'm not going to walk into something that's at market value in this market. I want to purchase something, even in any market, to be honest with you, but I want to purchase something well under market value. Okay. And by the way, did anyone give me a subdivision? Is there any subdivisions? Shoot. Okay, so I don't think anyone gave me a subdivision. Does anyone give me a subdivision? No subdivisions. So if you have a subdivision, give it to me because I'm going to do this right now. Okay. I'm just going to take one. All right, I'm going to put a subdivision Kings Mill. So the first thing we have to do is figure out what homes are selling for in a specific, and I got the Scottsdale. I'm sorry, I don't have access to Scottsdale. I'm just going to take Kings Mill. Okay. So the first thing is I have to do an analysis on the subdivision that I want to purchase in. Okay. So I'm just going to say it's Kings Mill. So the way to do this, guys, is first I have to figure out, again, over the last year, what they're selling for. So I go to sold properties here over the last year, and I'm locking it down hyper local into that subdivision. So when we go to results for sold, let's go to results. And remember, I'm only selecting properties that have a variance of, well, actually, I don't have a subject property. So I'm going to scan all of this just to get an idea because I don't have the property yet. So let's take all of this and we're going to divide this, go to tabular, and we're going to get our average price per square foot over the last year for this subdivision, which is $134.31. That is so important to have. So I go back to the form here. Really, the only things you need are these two right here. That's the hardest part, these two boxes. Once you figure this out, you guys can do so much math. So I put market value in the subdivision of Kings Mill is 134. Okay, so if I only wanted to buy in Kings Mill, I now can do that because I know the market price per square foot is $135. So when I go back here, okay, we're going to lock this down to Kings Mill, and we're going to see if anything's in Kings Mill for sale that's under value. So there's actually 17 homes. That's crazy. So there's 17 homes for sale in Kings Mill. That's just one subdivision, so that's really crazy. Okay. Now I'm going to categorize this by price per square foot because I want the cheapest home per square foot. And we'll analyze that right here. Look at this, guys. That's insane. So there's a home right here. Look at this. This first one, it's 104 square foot. So it's 104 square foot. This is a nice house. So there was a price cut of about almost 15,000. This home has been on the market 135 days. So I'm not sure what that guy's name is, but brother, I get that you think your market is like red hot, and maybe it is. Maybe it is, to be fair to you. But I could tell you that my market is not. And you can see that right here because this is selling for $104 a square foot when the average is 134 and it's $15,000 off, been on the market for what, 4 months? And look at the condition of this house. It's got a pool. What? So this even has a pool. That's insane. But either way, let's do an analysis. So we're going to take the sales price. We're going to note that. Okay, the 345. We're going to note the size of the property right here. We're going to note the subdivision. We already have that right there. Let me take my notes real quick. 92 and then 345. And then don't forget, you guys, then we go to the tax because we are going to also figure out cash flow. So we go to the tax tab right here and we see that it is overassessed by, holy smokes, by 80,000. Look at that. So they're paying taxes on this property as if this property was worth $434,000. That's what, over $80,000 they're being overtaxed on? That's geez. And look at their taxes per year. I almost fell out of my seat. $10,961 in property taxes per year. That's insane. Absolutely insane, you guys. So now that I have that information, I'm going to go back here. I'm just going to put the address is 12 Main Street and the purchase price. I already have that, which was the 345,000. The size of the house is 3292. The taxes was a whopping 10,961. Now, before I start doing numbers, I'm going to do the market rent per square foot as well. So all I got to do that is I do the exact same thing, except I go to the rental market analysis. And this just means it's only pulling comps for the rental market. So I'm going to go to sold down here for the last year, 365 days. I go to the subdivision, Kings Mill right here. Okay, 26 homes have been rented out. Dang, that's insane. Over the last year, let's take a look at results. And again, guys, this is kind of the gross way. If I was really serious about a property, I would be hyper specific, but we just don't have to do that right now. So let's look at the stats and let's go to tabular after we select all of this. And let's see what they're renting out per square foot. So they're renting out at $1.01 per square foot. So I'm going to go back here and I'm going to go $1.01 per square foot. Okay. So now what I have to do is calculate the estimated payment. You guys see that down here. In order to do that, I'm going to come right here. I'm going to put 345. Okay, I'm going to do a 5% loan. Conventional at today's rates is 6.25%. The property tax, I already have that. It was 10,961. You guys see how I'm doing this? Come back and watch this. I'm going to do 1% for home insurance, especially if you're in Texas. It may be higher than that if you're in Texas. Okay, for PMI, I'm going to do a percentage as well. I go 0.55 for PMI. I remove the other costs right here. And literally, I'm done. That's how, first of all, you want to contact your loan officer, but I was a loan officer, so I know how to do this. So I'm comfortable doing it myself. I'm not saying you guys should. By the way, if you purchase a $345,000 house, you pay back $1.1 million over 30 years. So make sure it's the right house. But I'm going to take this payment of $3,367 and I'm going to put it here. 3,300. And you guys, it took me 20 years to learn how to do this. 20 years. I'm showing you guys how to do this in 10 minutes. I'm telling you, this is amazing stuff. Now, I have everything I need. I'm going to do a 1-year comp analysis. Let me pull up a simple calculator. And this is what I'm saying, you guys. This is all simple math. We don't need mega data providers using methodology. Just give me the raw data. That's literally all we need. So the first thing we do is let's calculate how much under market value this is, how much wedge. So I take the size of the house, okay, 3,292 times the market gross, because it's not net yet. It's not net, it's gross, although that first property was immaculate and it had a pool. How is it immaculate, under market value, and has a pool? We're literally calculating something with a pool right now. So I don't even, we should add more value on that. But regardless, I'm going to multiply the size times the market price per square foot of $134.31 gives me a market value. Remember, this is market value of $442,000. So I subtract now the purchase price, and I'm going to get it lower than the listing price, but I'm going to minus that, $345. Okay, that's going to give me a wedge of $97,148. See how easy this is? This is why, and again, remember though, I had to filter 95% of the data to go right to this. The reason I can do this so quickly, again, is I'm filtering the data, so I'm not wasting my time. This has $97,000 roughly in gross reg by using this method, okay? Now, let's see if it cash flows, because I could tell you one of the massive problems out here in Houston is the property taxes and insurance and prices are so high still, you can't cash flow. Even $100,000 under market, you still can't cash flow. Let's take the size of the house again, times the market price per square foot for rent. So that's times 1.01, gives me gross rent of $3,324 minus my mortgage payment of $3,367 means that I'm upside down by $42 a month. So I am not cash flowing. So if I wanted to cash flow, I could do things like potentially more down payment and potentially a lower interest rate. But either way, y'all, that is going to conclude our market analysis. And I'm going to have that uploaded momentarily into our course. Now, and that course is for you. That took us 11 minutes, by the way. That actually took us about 10 minutes again. I could do this in 10 minutes. If your realtor's not doing that for you, fire them and get another realtor, because all realtors should be doing that. They should not be cheerleading. They should be using math to explain to you how wedge and cash flow works. Now, our next video is a doozy. Our next video is about how rent is possibly finally going down. Okay, so possibly finally going down. I just don't know what to believe anymore, but take a listen, guys. Let me know your thoughts. Let me mute this up right now.
Housing market that might be good news finally for renters. Of course, not so much for the rental stocks. Diana Olick is here with this week's property play. Hi, Diana.
Hey, Kelly. Yeah, we've got an exclusive early look read on November rent data out tomorrow. It's showing that continued new supply and weaker demand are pushing vacancies up and rents down. The national median rent for apartments fell 1% in November from October, according to Apartment List. It was the fourth consecutive monthly drop. Apartment rents are down 1.1% from November of last year and about 5% from their 2022 peak. Now, vacancies hit a record high of 7.2% in October. It was unchanged in November, and it comes after a really historic surge in apartment construction brought on by big pandemic demand. Now, since it takes a while to build a large building, this supply is still on the high side, still coming through the pipeline, although it is expected to fall back next year. Now, we don't have any recent data on multifamily starts because of the government shutdown, but the last read from August showed multifamily permits, which is an indicator of future construction, down about 11% year over year. Now, weakness in the sector is showing up in the stocks of the apartment REITs, names like Avalon Bay, Equity Residential, and Camden Property Trust. They're all down year to date. There is a significant lag time for these rent figures to get into the CPI numbers, which are a critical measure for the Federal Reserve in determining interest rates, but they will show up eventually. Now, for more on this and a big play on investment in early childhood real estate, head to the Property Play newsletter. That's cnbc.com/property.
You guys think of that? Is that good news? Is that good news finally? And what happened to hold on one second. I don't know. Is that good news? Maybe it is. And what happened to that guy, by the way? That guy, did you agree with what I said, that guy? I'm not trying to pick on you. I appreciate your difference of perspective, unless you're just intentionally lying. But I don't think everyone that disagrees with us is intentionally lying. I do think that okay, where are people going to go? Most people, to get information on the housing market, where are they going to go? Zillow. They're going to go to Zillow, or they're going to go to Redfin. And quite frankly, all they do is talk about how great real estate is and how you should buy. So why would we get upset at people that are being spoon-fed that narrative? And that's what, again, so just, I don't know if you're still there, but if you're there, let me know if you understood what I was doing with the math and whether or not you agree that we should be using math to purchase real estate and we should stay away from people that are emotional. I want to know what you think. Now, a couple updates I wanted to give you guys. On my socials and the advocacy, because I've been working, honestly, I've been going a little crazy. I've been going a little crazy, you guys, because I'm working like a madman to get this up and running. I finally have our video right here. So I have a welcome home video. This is going to explain what to do on the website. So it is coming together. This is an advocacy website. Again, there's home buying on top. I have an entire tab for you guys on home buying. Remember, I upload the course into how to do a market analysis. I have the protest property value right here. I just filmed the video today that's going to be uploaded. I have 3 videos of examples of me fighting and protesting property taxes. This is all, you all saw these videos, but it's all here, nice and organized. Here's the abolished property taxes. This is the update on like what we got going on with the lawsuits. This is a how to end property tax course right here. It took me days, weeks to make that course. It's all there. New amicus, the bill to abolish property taxes. Look at also that 1-page talking point on abolishing property taxes. I want you guys to use that. And I made a quiz for you guys right there. This is all for you. This is all for you. It's actually for us. Okay. And then when you go to more right here, you could go to the tax protest criminal complaint. And if you guys want an update on that story, it's all right here. We're going to do depositions next month. I can't wait to give you guys that. I meet with my attorney next week as well. Litigation support, school bonds. I'm going to teach you guys how to fight school bonds. It's all there. Now, if you guys can, do me a favor, if you're still on watching this, if you guys can, and I'll put the link in the notes, go to my Substack. Okay. Subscribe so that I can write to you guys. It's right here. It's a brand new Substack. You don't have to upgrade to get paid, but if you ever wanted support or even, in this chat, you can go there, watch it, follow along. I'll be doing a lot more stuff here. I'll be doing also a lot more lives, and our lives are going to be Tuesdays and Fridays. So I'm coming back to you guys Tuesdays and Fridays. So please go to my Substack. It would mean a lot to me. I'm going to get better and better at writing. Melody has been in my ear this whole time. And also, and this goes to you as well, Ohio Housing Nerd, I want you to go to my Facebook, please. Go to my Facebook. That's not my Facebook. My Real Estate Mindset Facebook right here. I want you to go here. There's only 41 members, but this gives us an ability to publicly post atrocities. So if you go and you catch someone slipping, here's where you guys can go to upload your video. I'm not, unless people get absolutely psychos, I'm not regulating this. I'm not suppressing anything here. You can go here. You can start uploading videos. But the best thing of all is there's only 41 people and you can start a conversation with us. I want you there, Ohio. I want you there. Okay, this is Ohio right here. I've been watching Ohio. I've been watching you, buddy. I've been watching this man right here. I've been watching him because honestly, I liked his set when I first started watching him. Now he's starting to go outside. He's starting to do things. But I also watched him because he started out having a little bit more hardlined opinion on the housing market. He's like, oh, I think, and I don't want to put words in your mouth, brother, but it was a little bit like, oh, watch out for the doomers. And I was like, this was at first, I was like, oh, another shill, right? That was what I thought at first. But then I started listening a little bit more and I was like, oh, he's in Ohio. Okay. I was like, oh, well, Ohio is one of the housing markets that's literally, statistically with the data is going up. The house prices are going up. It is going up like crazy, as is rents. So those comments help make me stronger because I do critical thinking. I'm like, why would this person say that? Because I don't think just because someone doesn't agree with what we're saying that they're a maniac or I don't think that at all. I think there's a reason why they're saying things, and I want to know what that reason is so that I can study the reason. And so I've been studying what he's been saying, and I appreciate his perspective in Ohio. Quite frankly, it makes me stronger. But Housing Nerd, I want you on Facebook. I want to talk to you about what's going on. Please go on Facebook, guys. Go to Substack, and also know that I absolutely love you guys so much. P Nice, I appreciate you. Course, it's been a long time, man. It's nice to see you, Course. I hope you're doing well. Where's Johnny? Where's Jeff? Where's Troy? Where's Nikki? I miss you guys so much. I'm going to be here a lot more for you. And having said that, happy Friday. Maybe do me a favor, guys. I'm going to challenge you right now. If you see someone in need, stop, help them. If there's someone behind you, pay for their coffee, their groceries, whatever it is. But this world needs a lot more love and a lot more unity and a lot more people being gentle. Let's stop charging people for things. Let's don't rip people off, but understand the purpose. The purpose is to love and to serve. At least that's my opinion. So I love you guys. I'm aiming to serve you guys. Check out all the links. And other than that, if you're out there investing in real estate, you guys already know. I wish you luck. Enjoy this outro, and I hope you
Thank you.